Hey everyone, it's Simon here. Welcome to your Accelerate Members Update for Thursday, the 3rd of August, 2023. I had a little bit of risk off yesterday. It's the first kind of a proper risk off session we've had in a little while. In fact, quite a few weeks really. S&P's down 1.4%. Nasdaq was down 2.2%. It probably felt a little bit worse than what it actually was, just because, like I said, it's been a while since we've had a move like that. But hopefully, what you're learning as you kind of watch me trade and watch the markets is why we hedge. All right, when markets are just going up and up and up, and it seems like there's sort of no end in sight, hedging can feel a little bit silly. And then you get a day like today, and you're like, okay, that's why we do it. So obviously we've had a very, very strong move up. I mean, really from here. But particularly this little part here, it's sort of defied many people's expectations. And I've said ad nauseum, I don't feel comfortable having long positions here without some hedges in place. Now, the beauty of buying cheap hedges, and that is hedges when your IV percentile's like 3%, is that when you get a move down in the market, two things happen. You make money on the delta because the put increases in value as the SPX or SPY falls, but you also make money on the Vega because implied volatility starts to explode. All right, so those puts that I bought yesterday or day before yesterday on the 1st of August at 650, I mean, they're up almost 50%. And it's not as if we've had a big move. All we've had is like a little gap down and a reversion to the mean. Market was only down 1.4% yesterday. But when you get the delta and the Vega working for you with the implied volatility rapidly increasing as well as the price falling, puts can become very attractive. My NLV yesterday was up about 2.5%, and that's despite the fact that I was 12.5% long, 7.5% short. So you'd think that a portfolio that's net long would have a tough time in a market environment like yesterday. But what's I guess underappreciated by people who don't hedge or don't trade options is that convexity that options offer when price moves in your direction in a short space of time. Like I said, the options sort of explode in value. Explode in a good way. All right, but just to, I guess, illustrate, hammer home the point, why we hedge, even if it does seem a bit tiresome, you're never going to pick the exact day that this is going to happen. But hedging when nobody wants to buy insurance, it's like buying umbrellas in the sunshine. All right, they're much cheaper to buy than 10 minutes after the storm has started. The analogy I use in the How to Hedge program is you always want to buy house insurance before your house catches fire. If you're trying to buy house insurance a few minutes after the downstairs guest room has started smouldering, well, it's going to cost you a lot more. If we take a look at the Nasdaq, it's going to look very, very similar. And what we've got in both of these is a pullback to the mean. All right, so that is just so far a nice orderly pullback to the mean. This one looks a little bit more dramatic because we had a kind of a gap and crap sort of setup here where we gapped down at the open and closed nearly at the lows. So we could certainly see some follow on. Now, ordinarily, I would think we've got a strong trend, strong bull market, pullback to the mean. Let's get ready to buy the dip. I just think it could be a little bit premature to do that, for a whole host of reasons. So let's look at technical reasons first of all. Let's look at some of the correlated markets. I'll bring up a chart of the dollar. And it is no coincidence, all right, that the Nasdaq drops 2.2% on a day where the dollar is closing above its 50-day moving average. Remember, rising dollar is a headwind for risky assets, including equities, and this dollar strength, as I've been saying all along, is going to be a headwind for stocks, particularly if this downtrend becomes an uptrend. You can see the ATMA has crossed above the 21 and the 34, prices above the 50. It looks like it's got a date with its 200-day moving average. All right, that'll be the next big test. But if the dollar has got a short-term upside bias, stocks are likely to have a short-term downside bias. All right, let's have a look at the bonds. Let's check out the 30-year bonds. So I've been saying for months, movement in bonds doesn't really mean anything so long as they're within this range. Well, guess what? They've broken out of that range. All right. Again, it's no coincidence that tech is having a really rough day at the same time as bonds are breaking below support. Let's have a look at HYG, junk bonds. Again, it's no coincidence that the S&P and the Nasdaq are having a rough day, just as HYG gaps below its 200-day moving averages, in fact, all of its moving averages. It's gone from looking as though it was slightly in favor of the bulls to now slightly in favor of the bears. In yesterday's video, we talked about seasonality. All right, we talked about how August and September are the worst 2-month period for the market on a seasonal basis, and how we should expect some sloppy sideways to down action over the next 2 months, which would be a big contrast to what we've seen over the previous 6. Okay, but seasonality, it's kind of reared its ugly head almost like clockwork here. The other reason why I wouldn't sort of jump in and start buying the dip is, of course, we've got Apple and Amazon earnings out today after market. And if they don't surprise to the upside, there's every chance they could sell off, given the tremendous run both of those stocks have had into this second quarter earnings. So let's look at an example in Shopify. So Shopify announced earnings yesterday after market. They reported adjusted EPS that was triple estimates on revenue that was 4% higher than estimated. Gross merchandise volume was up 17% year on year and beat estimates by 3%, while gross margins also beat. Third quarter revenue growth is expected to be in the low 20s%, but on higher margins. What did the stock do? It was down 7.44% yesterday. So you kind of think they did everything right, and yet the stock still sold off. And we saw that with Netflix, we saw that with Tesla. Both came up with EPS beats, and both of those stocks sold off after earnings. And look, we've also got the jobs report on Friday, and if that comes in hot, that'll get the market thinking more seriously about the prospect for another rate hike or further rate hikes. And if the market is already of a mood to take a bit of profit, reduce a bit of risk, that will only exacerbate that sort of behavior. What I'll do now is go through and have a look at my positions. Let's start off with USO, where we're basically sitting on a double even after yesterday's fall. I'm happy to take the money and run here. Hey, Simon here. The video you just watched is an excerpt of a market update video that our members receive every trading day in the Options Academy Accelerate program. If you enjoyed the video and you'd like to learn more, head on over to toweroftrading.com/accelerate. You can check out the highly acclaimed Accelerate program, a mentorship program we offer. Again, the URL is toweroftrading.com/accelerate. Check it out, and I look forward to seeing you on the inside.